Good evening, and thank you for joining in this webinar on Bharat Bond ETFs. Um, as you all know, we are all here. More than 250 people have joined. Really appreciate your time in in this days of people working from home and in the current situation. Really appreciate you all joining here. So what we have today is an update on this Bharat Bond to ETFs, the second tranche. As you know, the introduction of corporate bonds ETF in India was through the launch of Bharat Bond ETF. The first tranche, I think, we launched in December 2019. It was very successful. All of you know how it's got traded and how the returns are. So we're launching the second tranche on July 14th. So as NSE, we are working very closely with the Department of Investment and Public Asset Management, DIPAM, and Edelweiss Asset Management Company to get this bond to you. So the biggest advantage of the bond is, one, it's listed on NSE. So obviously, being all our trading members, you get an opportunity to trade on NSE. We've got ANMI also with us, which we've done this program with ANMI so that we can reach out to maximum people possible, and you in turn can reach out to your clients and sensitize them about this product. And of course, this product has got other advantages. I mean, as an ETF, you've got stable returns. The cost of ETF is low. There's no lock-in. There's high safety. So there are multiple advantages of an ETF. And India, as an ETF market, has not become as big as it should be. But we have done very well in equities and derivatives, as you all know, thanks to you. So we will, definitely reach that milestone in ETF at some point of time. So. So what we have today is, we have Kamlesh Shroff, Director of ANMI Western Region, who will also give an introduction after I speak. Then we have Mukesh Agarwal, who's the CEO of NSE Indices, and we have Radhika Gupta. She's from the MD and CEO of Edelweiss Asset Management Company. So the idea is to spend some time and introduce the product, introduce the concept. Mukesh will also talk about how the existing product has been and how the returns have been, so that you can in turn take it out to your clients. And we at NSE are very happy to launch this, because from our perspective, this is a big step in the bond market and in the ETF market to get a product like this in front of you. And already the first tranche has been successful. I think that's why there's lots of interest in the second tranche as well. We have got a number of queries on this, and we'll be more than happy to resolve in case you have any queries. So as you already know, we have done these webinars in the past. Any questions you have an option on your screen to type your questions and give it to us, and we will take that question. Mukesh and Radhika are there, and even I am there, and Anmi is also there, with Kamlesh Shroff is also there. Any questions related to this product, we'll be more than happy to answer. And without much ado, thank you very much for being here. I'll request Kamlesh Shroff for his remarks, please.
We at ANMI generally take all of these different types of webinars, which are educational and awareness webinars, and a host of them that we have done them in the past, just to handhold all the members so that they manage to get a little leeway in terms of what's the new offerings on the table. I think today's session gives members and the clients an opportunity, as rightly said by Hari, to invest in a well-crafted instrument by Edelweiss, which is going to be listed on the exchanges. NSE has taken the lead in terms of doing the first two, sometimes in December, and I've been given to understand that there has been reasonable volumes in both of those instruments, which I suppose we will get more details as we move forward. But at the same time, both these instruments have got two maturities, and I suppose now two more instruments that come in will have almost four concurrent maturities. So, and in the current scenario where retail participation, I think, is the strength for Indian bond market, I think this is a great step forward. And of course, I'm very sure that the first part is that all of these ETFs is the best way to go through because there's liquidity. At the same time, it's all the best paper. So it's all AAA paper that they will be investing into. So I guess this is the prerequisite for a nice and vibrant, dynamic bond market that all broking communities looks forward to. From both perspective, that broker as intermediaries will also benefit in terms of the doing business. At the same time, the client gets another option in terms of employing their savings into the market. So I think it's surely going to be a success. I congratulate the Edelweiss team for successfully innovating the first product, which I presume garnered approximately 12 or 14,000 crores. Not very sure on the figures, but some so what. But and at the same time, NSE team, both the NSE exchange team for listing it on their platform and giving the liquidity. At the same time, the index team, which is headed by Mukesh, to kind of jointly be together and put this up. I think couple of highlights that I have personally felt is that this is a great high safety exchange traded on a T+2 fairly liquid bond that any investor wants to invest gets a little higher rate of return than your normal 4.5% or 5% FDs that you kind of put in. So a little 20% or a 15% higher, but very important is the liquidity. So you want to kind of exit, get your money out, you kind of sell into the market, get your money, and you exit. And the best part of it is, I suppose that it is at the most lowest cost because it's an ETF. So for every 2 lakh investment, I think it's about a rupee cost or something. And as rightly said, that they have a predicted maturity date. So there is it's like known that this is what your rate of return is. Besides the point that you need to keep an eye that if the interest rates go up, then maybe you need to look at it from that perspective. But current scenario doesn't look like. We're all sitting home in COVID and stay home, stay safe types. And I don't think corporates are willing to put in the extra money. And of course, the global markets are sloshed with enough liquidity. So I don't think currently that's it. So without taking much of the time, I thank NSE, I thank Edelweiss for this platform, and all the very best. I'm sure it's going to be a success. Thank you.
Thanks, Kamlesh bhai. I think you have set the ground right. You correctly mentioned about the key features and highlights of the product. So we as an exchange, we are really proud to be associated with this product, and I personally am very proud because we have been working on this product right from the day it was announced by the late Shri Arun Jaitley, ex-finance minister. He had announced this product somewhere in 2018. And since then, we at LSE, we have been working very closely with DIPAM, Geo Government of India, Edelweiss Mutual Fund in conceptualizing the product. And I think this product is very, very unique. So basically, I'll come about the product in details and Radhika will talk more about that. I thought before we move forward, I should just set the ground and talk a bit about the ETFs market, because ETF markets in India have grown. But we believe that we have a long way to grow, because globally ETFs or passive investments are becoming very, very popular for the right reasons. What Kamlesh bhai said, that low cost, traded, and you can buy the entire basket. You don't have to run around picking up individual stocks. So that is the key reason. So let me start with the global scenario. What is the global scenario on the ETF markets? So today, if you look at globally, the size of the assets under management in global ETF industry is something like $6.11 trillion US, $6.11 trillion US. And 1 year back, the size was around $5.3 trillion. So the industry has been really growing in leaps and bounds. So if you look at the global growth over the last 10 years, the global industry has grown at the rate of around 18%, which is not really a small number. And if you look at within that Asian markets have grown at around 25% per annum. So that is really, again, a very good rate. And globally, if you look at, I talked about $6.11 trillion is the AUM. And within that, US is the largest market. US is around 70%, then followed by Europe. Europe would be around 15%. Then comes Asia. Asia is 7%. And if you look at it in terms of number of instruments, number of ETFs listed globally, they would be something like 8,700 ETFs listed, issued by around 453 providers, and they are trading in 71 exchanges in 58 countries. Now, within ETFs also, you can have ETF on any asset class. You can have ETFs on equities. You can have ETFs on debt. You can have ETFs on commodities. You can have ETFs on currencies. So globally, if you look at the breakup, yes, equity is the largest. Equity ETFs account for 73% of the assets of 6.11 trillion, followed by debt. Debt ETFs is around 22%, and the remaining 5% is commodities and currencies. Now, globally, I just share about globally. If you look at the trading volumes in debt, information we gather, the trading volumes in debt ETFs is more than the trading volumes in the underlying corporate bonds. So the trading volumes in ETFs is very, very large. And even if you look at the liquidity aspects in terms of bid-ask spreads, so bid-ask spreads in debt ETF is something like 1 to 2 with 2 paisa, as compared to the underlying bonds wherein the bid-ask spread could be 49 to 50 pesos. So that is the kind of difference we see in trading in bond ETFs versus the underlying bonds. So bond ETFs have become very popular globally. Now coming to the Indian markets. So if you look at the Indian markets, yes, today we are large. So our markets, the first equity ETF or first ETF in India was launched somewhere in December 2001. It was Nifty Bs, which was tracking Nifty 50 index. And I think after that, from 2001 to 2015, the market relatively remained very small in size. Why I say that? Because even after 14 years of existence, the AUM and the asset under management of ETFs, equity ETFs or debt ETFs in India was only 8,000 crores as on March 2015. So basically, if you look at it from launch in 2001 and within 14 years, we had only had 8,000 crores of AUM. But the whole thing changed in August 2015 when EPFO decided to start investing in equities through the ETF route. And that's when the whole thing changed. And after that, if you look at now, today, when I speak to you, the asset under management has gone up to 1.6 lakh crores. So that is really very significant, from 8,000 crores in March 2015. Today, it is around 1.6 lakh crores. And that point of time in March 15, we had only 34 ETFs. Today, we have around 76 ETFs. And if you want to look at the breakup, so within the breakup also, out of 76 ETFs, today we have 68 ETFs are equity and remaining 8 would be debt ETFs. And in terms of assets, out of 1,60,000 crores, equity ETFs would be 1,43,000 crores, and the remaining 73,000 crores would be the debt ETFs. And debt ETFs also, I think out of the 17,000 crores, approximately 13.5 to 14,000 crores is Bharat Bond ETF. So debt ETFs have just started taking off. So today, in terms of assets, the debt ETFs account for 10% of the total AUM of the ETF size in India. Globally, as I said, it is around 22%. So debt ETFs also have a big way or lot more to go forward. Now, within the equity ETFs also, I think Nifty 50 is the most popular index, your favorite index, Nifty 50, which is the benchmark index of India. So almost 82,000 crores of assets are linked to Nifty 50. So within 1,60,000 crores, almost 50% of the assets are linked to Nifty 50. And here also, just a quick small statistics. Out of 76 ETFs or 1,62,000 crores, 1,60,000 crores of AUM, so the ETFs linked to NSEs or Nifty indices account for almost 78%. So 78% of the assets are linked to Nifty indices, and we are really proud of it. Now, in terms of investments, I think that is one number which is not out of 1,60,000 crores today. Institutional investors play a very important role. So they account for almost 91% of the assets, and retail investors are just 9%. But one positive sign I would say, because last November when I was speaking in our NSE's ETF conference, the retail investors at that point of time counted only for 7%. So within last 6 months, that contribution of retail investors in the AUM has gone up from 7% to 9%, I think, which is very heartening. And I would assume that there a major role would have been played by the Bharat Bond ETFs also, because Bharat Bond ETFs, the first tranche which was launched in December 2019, more than 50,000 retail investors have come in. And before the conference, I was also checking in number of folios on the AMFI website in the ETF side. So today, I think May end, there were 21.63 lakh folios in the ETFs, written equity ETFs. And good, I think what excites me is almost 1.6 lakh folios got added in the month of May itself. So April end, the folios were something like 20 lakh folios. And May end, it went up to 21.63. So almost 1.6 lakh folios got added in 1 month as per the AMFI data, which is really very, very exciting. In terms of trading volumes, I think again the trading volumes have been going up. If you ask me, is it high? It's not high, but I think trading volumes have been really going up. It averaged trading volume per day, both debt plus equity. It used to be something like 98 crores per day in FY 16-17. And if you look at the average trading volumes in the month of April, May, it has gone up to around 224 crores. So, and the breakup of 224 crores would be around 86 crores per day is equity and around 134 is the debt. And within 134 crores, Bharat Bonds average trading volumes per day is 11 crores. I would say from my experience and what I have seen, for a new instrument to come in the market and garner a trading volume of 11 crores per day within 2-3 months is really a very positive sign. That just shows that the kind of interest investors have in this product, and because the product has got its own inherent benefits and positives, I will briefly talk about it and Radhika will talk about it in detail. Now, as I mentioned, average daily trading volume of debt is around 134 crores, out of which Bharat Bond is 11 crores per day. So the balance amount is mostly due to the overnight fund ETFs. There are 2 overnight fund ETFs. There the trading volumes on the higher side. Sorry, where the trading participants park their surplus funds overnight. This basically overnight fund ETFs track our overnight index or 1-day rate index of NSE, and wherein the people park the surplus overnight funds. Now, coming to the Bharat Bond ETFs, I think, so that was a brief about the ETF industry in India and the way forward. So we personally, we believe that we are quite positive. We believe that industry, ETFs will grow, and people are talking about innovative ideas, quantitative ETFs, ESG ETFs. There are various themes on which me and my team are working on, and we believe that all those ETFs will be launched going forward. We expect many more ETFs to be launched, and we believe that the interest from the investors, from all of you, will keep increasing in this product, and that will help the product to grow both in the assets as well as the trading volume. Now, basically, this Bharat Bond ETF first tranche was launched in December 2019, and this is an outcome of government of India's vision to improve the way government-owned entities raise money through bond market and also increase retail participation in the corporate bond market. As I mentioned, the first tranche was quite successful. It mobilized almost 12,500 crores. But heartening thing is more than 50,000 retail investors participated in this particular instrument in the initial offer. As I mentioned earlier, this is almost 3 years back. This was announced by our ex-finance minister, late Shri Arun Jaitley, in the Union Budget of 2018. Since then, NSE and NSE Indices has been working with Government of India on the construct of the product, what is best suited for the Indian markets, and even Edelweiss and Government of India, we have been working on it. And I think finally, what we came out with and the product finally we launched, we believe that this is the ideal product for the Indian markets, because what this product is, or the corresponding, we have played the role of basically launching the index, because as all of us know, any ETF has to track index, and so we have launched that index, and this is basically, we call it in technical jargon, this is the target maturity ETF or target maturity index. So basically, whatever is the index, the ETF will mimic that. So what we mean by target maturity is each index has got a particular expiry. So the index will expire on that particular day, and accordingly, even the ETF will expire on that particular day. So the first 2 indices which were launched in December 19, and based on which the first series of Bharat Bond ETFs were launched, so there the target maturity was April 2023 and April 2030. So one had a tenure of around 3 year plus and 3 year 4 months, and other one had 10 year 4 months, again 3 year plus 3 year 4 months more from the tax things. So that is one. And second thing, it comprises of AAA rated government owned entities. I think that's what results in the kind of safety which brings into the whole thing, because if you all of us have seen that last couple of years have been really turmoil in terms of credit quality. There have been defaults, companies have been defaulting and all that kind of stuff. So people are looking for safety. So what more do you want, which is a passive fund which just tracks the index? Index consists of AAA rated government owned entities, and it has got fixed maturity. And the biggest advantage of fixed maturity is when you invest in the index, and whatever is the YTM or the yield to maturity at that point of time, and one keeps holding on to the ETF till maturity, then in the most likely scenario, your returns are expected to be around the YTM. I think that is what it is. So, and we believe that in India, people like investing in fixed deposits. People like in instruments which kind of indicate what kind of returns and which are fixed maturity. So that is what this particular instrument offers. Otherwise, you do have other instruments wherein there is no fixed maturity and it keeps you a fixed tenure. So I think that is the biggest advantage. And as Kamlesh Bhai mentioned and Hari also mentioned, this instrument has the biggest advantage in the sense that it is a low cost, good credit quality, very tax efficient, and it is traded on the exchange. In case of liquidity, one can get out of sell the ETFs on the market and get out. Now, as I said, we are going this indices or the ETFs are target maturity. So in December 19, we launched two indices, which were April 2013 and 2030. And now, last week, we launched two indices. One is expiring in April 2025, and the second one is expiring April 2031. So now, after this product, the second tranche get launched, the investors will have a choice of investing in 4 papers or 4 ETFs, depending on the cash flows, whether they want the cash in 2023, then they can invest in the ETF maturing in 2023, or you can invest in 2025, 2030, 2031. Depending on your cash flows, depending on the requirements, you can in strengthening and deepening the Indian corporate bond markets, and probably that will also help in creation of a viable alternative to institutional channels for short-term and long-term financing needs of it. Today, because in bonds, you have only institutional investors, and there is a need for the retail investors also to invest in the bond markets. So I think with this, I will not take more time because only finally I would just say that we believe innovation is very important for the development of the capital markets. We at NSE, our focus will continue to be focusing on innovating new products. We take pride in working very closely with the government and Edelweiss and innovating this product. And our endeavor will be to keep innovating, keep coming out with new product ideas, new indices going forward also. That's from my side. So now I'll request Radhika to start with the presentation. Radhika, it's you. Over to you.
Hi, Mukesh. Thank you to everyone at NSE and the team at ANMI, and thank you, Mukesh, for having me, and thank you to the audience, the 300 odd people who are here on a Thursday evening. I always find it incredible in this time of webinars. In fact, I think Mukesh did a wonderful job of recounting our history launching this ETF. But one of the fascinating things in this new, someone asked me in the media, what's new about this NFO? And I said the fact that we are trying to raise so much money while sitting at home in itself is a new feat. In the last NFO, I think Mukesh and I took some 50 odd trips to Delhi. So this time we're doing it digitally, so it's digital India all the way. what I'm going to do is I'm going to project my screen and share a presentation. So give me 1 second. I'm just doing that. And if you have any problems, I also have a legendary ability. My internet is legendarily weak. So my colleague who's head of products, Niranjan Avasti, is also here. In case I do get dropped out, he'll continue and I'll hop right back in, but we're both here. So I thought I would divide the presentation into 3 parts. Mukesh, you can see my screen, right?
Yes, we can.
Yeah, we can see your screen. Yeah.
Yeah. So I'm going to divide this, and if everyone else could be on mute, I'm going to divide this presentation into 3 parts. In part 1, I'll take you through the basic features of Bharat Bond ETF. In part 2, I'll just talk about some of the highlights of Series 1, its performance, AUM, and I think Mukesh shared some of this data, but I'll share a little more. And in part 3, I'll talk about the case for investing in Bharat Bond at this time, given interest rates, and why we chose these 2 tenors. So I think if you look at a debt investment, the last 2 years have really highlighted the challenge of investing in debt funds. There are 2 things that customers seek from debt investments. One is, of course, safety. I mean, the question that you can't compromise safety is now very well established, especially through this credit period. The second is stability of returns. I think we are by nature FD investors who say कि इतने सालों में अगर FD करेंगे तो इतना मिलेगा. And to take duration risk and be subject to the vagaries of RBI, क्या कर रहा है, नहीं कर रहा, that's always been challenging, and that's been my challenge with some of the duration and yield products. So I think stability of predictability of returns is very important, and this is something that we debated a lot in the construct of this product. 2 other things that are very desirable in my opinion are lower tax and of course liquidity and lock-in, and I'm talking to a community where liquidity is of course very important. And I think in Bharat Bond ETF, what we've tried to do is put all these 4 things together. Sometimes people ask me what Bharat Bond ETF is. Is it like a stock, or is it like a bond, or is it like a mutual fund? And we really believe it combines features of all these products. Like Mukesh said, because it is a target maturity structure, it's got a fixed maturity date, so it gives you the predictability of returns of holding a bond. I mean, you are just buying bonds and holding them to maturity largely. So interest rate risk is relatively low. But unlike a bond and like a mutual fund, you're not taking single bond risk. It's diversified. So I think that is very, very important. And it's also professionally managed. And you have the tax efficiency of a mutual fund that does not necessarily come in bond issues. And like a stock, it's trading. I mean, it's an ETF, it's trading on the exchange. We'll talk about liquidity, but Bharat Bond becomes the lowest cost mutual fund product in India, and actually the lowest cost debt fund product in the world. I mean, when we check the data, I think the cheapest debt funds and the cheapest actually funds globally also are in the 3-4 basis point range. So at 0.0005% for the ETF, it becomes very cost efficient. And also it's a vehicle with high degrees of transparency. One of the questions that often gets asked in other products is, I don't know what's going on, something like the FMP of the past. I think that goes away here. So that is what Bharat Bond tries to bring together. In a minimum investment of 1,001, what is your universe? Your universe is AAA-rated central public sector enterprises. I would highlight that CPSE companies are those owned and managed by the government of India. IL&FS was not a CPSE. These are owned and managed by the government of India, and that's very, very important. I also want to highlight, because there's been some confusing media around this, this is a complete AAA issue, and it will remain a AAA issue. The last issue was also a AAA issue. If we were to do a AA issue, etc., it cannot be done in this particular thing. You'll have to launch a new index, you'll have to get new maturities, you'll have to get new SEBI approval. So this is a strictly AAA rated issue, and the proof of that is, of course, the index definition, as Mukesh alluded to, is a AAA one. So AAA CPSCs is the underlying universe. And each of these has a defined maturity. Last time we launched 2023 and 2030. This time we launched 2025 and 2031. Mukesh already talked about this, but because it's an ETF, it is backed by an index. NSE launched both the indices, so each of the ETFs have an index. And I think the index is very, sometimes people ask me, what does the index bring to this? I think the index brings most comfort to an investor. Ultimately, any ETF is a rule-based investment, and with an index in place, the job is just to replicate the index in line with SEBI guidelines. So there is no discretion of what to buy. I think this distinguishes this product significantly from the FMPs of the old also. In terms of what the index does, and while Mukesh is the expert, I'll run through the index. The index looks at a universe of AAA-rated bonds issued by CPSCs, and it looks at CPSCs that have bonds maturing within 12 months prior to the maturity of the index. Then you assign weights to each of these CPSCs, and the weights are based on the total outstanding amount. So bonds with higher outstanding amount have higher weightage. Single security exposure as per SEBI guidelines is capped at 15%, and the index is rebalanced quarterly. Maybe in the Q&A, Mukesh can talk a little bit about the quarterly rebalancing, but that is essentially the process. You have an index that NSE publishes. The index will have a similar maturity compared to the Bharat Bond ETF. It has AAA rated bonds. It's weighted based on outstanding, and it's capped at 15%. In terms of options today, we are launching a 2025 and a 2031 series. So investors have a mid-term option and a long-term option. As Mukesh says, now in the yield curve, you actually have 4 products there for customers: a 2.5 year, a 5 year, a 10 year, and an 11 year. What I've shown you on the screen is the indicative yields. I mean, they do change day on day, but these are the indicative yields of the product. And I think it's really nice now. People ask me, should we do the 2 or the 5 or the 11? And I said, the great thing about having a yield curve is now you can match your goals, what we globally call laddering. You can match your goals to the maturity of the index. While this is a community of brokers, I do also understand that some clients do not want to invest on the exchange. They don't want to do all that, and they don't have demat accounts. So we've also created a simple fund of funds option for people. The fund of fund just buys the underlying ETF. So people can either come in via the ETF or the fund of funds. ETF investment we are all familiar with. Fund of fund investment is just like a mutual fund. Purchases and sales are at NAV. The ETF is costed at 0.0005%. The fund of funds is costed at 0.05%. So it's not very expensive either. In fact, it's cheaper than every other debt mutual fund out there. So both options exist depending on what customers choose. We've actually seen great growth in the fund of funds series over the last year. Since the NFO, I think we launched the fund of funds at 600 crores. It's now more than 2,000 crores. So that option also exists for your customers. So why should you look at Bharat Bond? To summarize this section, I think a high degree of safety that comes with AAA CPSCs, significant stability and predictability because of the target maturity structure, the cost and transparency of an ETF, and then the tax efficiency and liquidity that comes with the MF investment. Mukesh also mentioned that one of the big benefits of a structure like this is also the the tax efficiency. So after 3 years, you qualify for capital gains taxation. This is what the math looks like. We've done an FD kind of traditional investment versus Bharat Bond. So there is a significant delta in both series compared to a traditional FD. And I think this is one of the most powerful slides to show clients that, you're getting a similar credit quality kind of instrument with liquidity and tax efficiency. You can look at the constituents of the index. These are some of the participating CPSCs in 2025, and these are some of the participating CPSCs in 2031. This issue will open on 14th July till 17th July. 25% of the issue is for retail investors. The retail application starts at 1,001 and goes to 2 lakhs. Thereafter, everybody else falls into the balance 75%. We are looking to raise somewhere between 3 and 14,000 crores. It's a wide range because we know it's a COVID period, but I must say the response on the investor roadshow has been very encouraging this time. In fact, I would argue it's almost been better than the first one. Now, a couple of statistics about the first Bharat Bond. So we launched 2023 and 2030. AUM at launch was 12,500 crores. AUM now stands at more than 14,000 crores today. We have seen a lot of switching, I have to say, between the 3-year to the 10-year, which is a function of where interest rates have gone. But I'm very encouraged to see that the 10-year has gone from 5,000 to almost 10,000 crores. I think it's one of the longest maturity. I mean, it's actually the largest long duration debt fund in the country today. In fact, when we launched the 10-year, people said, "Ki kaun itna paisa dega? Kaun 10-year mein invest karega?" Because our money has largely been in MF, institutional, short-term, liquid, etc. But to see this series grow and blossom has been very exciting. I put the annualized returns at the bottom. I would not go by these numbers. I'm openly saying that. I would go by the indicative yields. The first series really benefited from a big interest rate cut. So there's significant positive MTM. So this is not a number to go by, but since we have to put it there, we do. The number to go by is the indicative yield that I just showed. Liquidity, Mukesh already talked about this, but I think there has been significant liquidity. As he said, these series are trading about 11 crores a day. I think compared to some of the other ETFs, that is significant. The 2030, I think 85% of the time has been trading at a premium. Even the 2023 has been trading at a premium more than 50% of the time. And I think that is also a sign of some demand coming in on exchanges. So that's a positive sign. In addition, outside of exchanges, we also provide liquidity to large investors through the AMC. And I'm happy to say we have honored, even in this tough debt period, March, April, May, very large amounts of subscriptions and redemptions from investors. The 2023 has seen 4,000 crores of redemptions. The 2030 has seen 4,000 crores of subscriptions. And we have seen single day subscriptions and redemptions of as big as 750 crores in a single day, both sides. And I think we've been able to process this cleanly. So I think that tells you a little bit about the liquidity of the product, even for large tickets, at a time when bond market liquidity has been so stretched. Now, last point I wanted to make is, how does this look from a yield point of view, given where interest rates are, because we are in a lower interest rate regime. I think one thing that you have to realize is that interest rates, of course, have steepened on the long end of the curve because the RBI has been doing LTRO and TLTRO. In fact, if you look at this, and this is the GSEC curve, the red line is December, the June is the blue line. Short-term interest rates have fallen significantly more than long-term interest rates. And when we were thinking about which series to launch, instead of launching the usual 10 and 3, we decided it would be good to launch a 5 because there's a significant premium of the 5 over the 3. If you look at the PSU yield curve, it has steepened, and even today there's about a 50-60 basis point premium in doing the 5-year over the 3-year. The 3-year has been popular with mutual funds, but there are no 5-year products out there, and I think for medium-term investors, the 5-year becomes very exciting. Long-term story for the 10-11-year, of course, is also very good. The other thing to keep in mind that India's yield curve steepness is actually the highest among its peers. So 10 over 3 spread in India is at 140 basis points compared to 50 to 70 in most parts of the world. And this is an interesting chart. The dark blue line shows you the PSU index. The light blue line shows you GSEC. So there is a reasonable spread of PSU bonds to gilt. So for a little more risk than gilt, for quasi-sovereign risk, you're actually getting a significant premium on returns, which is why we think it's a good time to launch this today and to launch in the 5 and 10-year bucket. So I definitely wanted to share that. Last thing I wanted to share is, people do ask, what happens with mark to market? I mean, one of the risks in this product is interest rates go up and you will have some MTM. If you're a holding period investor, it's not a problem. But if interest rates go up, you will have that. So this is if you're doing a 2031 investment and you just want to hold for 3 years as a interest rate play or as a trading play, this is what your yield movement will result in returns. So the left is your movement in yield, 25, 50, 75 basis point rise and fall. And the right is your CAGR return. And the point I'm making is that even if there is a 75 bip spike in yield, the customer return is not bad even after factoring in mark to market over a 3-year period. Obviously, if you're there for the 11-year period, there's no problem. But it's worth seeing this for a 3-year and also a 5-year duration. In fact, over 5 years, it really won't matter. So this is just something to keep in mind because people are talking about interest rates. Another one to think about is how this compares to tax-free. Actually, this is a little dated, but if you look at tax-free bonds of the same issuers, they were at 5 when we made this presentation. I've been told they've actually fallen well below sub 5. So this is 5-year tax-free bond versus Bharat Bond for better liquidity and the same credit quality and more diversification. You're getting a better deal on the 5-year and a significantly better deal on the 11-year. So that's also something to keep in mind. I think what I'm going to do is stop there because I've covered quite a little bit of material. Mukesh, maybe we can take some questions. I'll stop sharing the screen.
I think we should do that. So I think, thanks Radhika, thanks. I think that was really very useful and very insightful. I'm sure everyone would have found the presentation very helpful. In fact, I have a lot of questions. I don't know how many questions we will be able to handle, but we have a big list of questions. So
okay, go for it.
Yeah. So I think first question I will ask is, how do the brokers who don't have ARN numbers will get brokerage on mobilization?
Okay, how will you get brokerage? So I am not a brokerage expert, but I think what you can do is Deepak Jain head sales for us. There are incentives that we are giving out. We don't give them in regular course, but in the NFO, we are trying to do something in terms of per application and things like that. So Mukesh, if this team maybe can connect with Deepak Jain, Deepak, then that will help.
Yeah.
And if you can do it quickly, then we can sort something out.
Okay, so this question is by Mr. Anup Khandelwal, so we will try to put him in touch with him.
Yeah.
Okay. Now, I think another question was, what is the expected YTM? I think you had already covered this. You can again tell them this thing, what is the expected YTM?
Look here, guys, yield move on a day-to-day basis, but I think, one sec, I think 5.6-ish to 5.7 and 6.7 to 6.8. I just projected it on the screen so you can see.
Which is as on today, yeah, correct. So now I think another question, which you have partly answered by Mr. Suresh. Liquidity is the main issue. Even tranche 1, this problem is there. How are you going to address this issue?
So I think, Mukesh, maybe you can speak to liquidity, but we put in market makers on tranche 1. We are putting in the same guys on tranche 2, and trading is happening. So 5 crore, even I've had many 5 crore investors, and if they come to us and we talk to market makers, you are able to do exits. I forgot to mention that the average bid ask has also been in the 5-7 basis point range. So it's not been bad at all. And as you said, 11 crores of daily trading volume is pretty high.
Okay. Okay, now another question is, I think, from Mr. Balchandra Pathak, and question is it secured, unsecured government bonds or public limited companies? And will it be tradable, non-tradable? What would be the approximate rate of interest? I think interest yields you have already indicated. The question is, will you be investing in secured or unsecured bonds?
PSU bonds are almost always unsecured. CPSC bonds are almost always unsecured. So unsecured.
Okay.
PSUs you don't usually issue secure bonds. Okay. And by the way, we will not be investing in AT1 bonds or bonds with call options or any structured bonds.
I think one question is, I think, from Mr. Hitesh Shah. I think you can answer this, and please share some good material which can be shared with the clients and easy to explain. He has given his ARN number also 60554. So Mr. Hitesh Shah, what we will do is, since you have given us your ARN number, so someone from Edelweiss AMC will get in touch with you and they will share the material. But what I know is, I think Edelweiss AMC has really prepared very good material on Bharat Bond ETFs, right from the first tranche to the second tranche, which explains all the benefits of ETFs and Bharat Bond ETFs, how does it work. You can download from there also, but to be specific, I think, Radhika, someone from your team can get in touch with Mr. Hitesh Shah.
Yeah, Niranjan, call if he can note down the ARN and we can get in touch. I would just encourage everyone to visit bharatbond.in. All the material, including the presentation I showed you today. So the presentation I showed you today, or there are WhatsApps, there are little videos, there is a lot of content, there are indexation simulations. So www.bharatbond.in is a great place to download all the material. In fact, ARN holders can also download pre-filled application forms with their ARN.
Okay. Now, one question from Mr. Vinod Goyal, I think to summarize the question, basically he is asking, what is the surety that for senior citizens, their capital will be protected if not appreciated?
Now, 70 guarantees of capital, but I think in terms of credit risk, this is one of the highest credit quality products in the MF industry. I mean, I think Crystal was saying that in the last 5 years, no AAA rated CPS has defaulted. So I don't think it's a product with capital risk if you hold maturity.
Okay, so that's good. So, okay, and then one question is, I think, which I can answer from Mr. Bharat Shah from Ventura. During the tenure, underlying instrument becomes from AAA to AA, what happens? So basically, if you look at our index, I will answer this question. So basically, as all of us know, the ETFs will mimic what the index does. So basically, and as we mentioned initially, this index comprises only of AAA rated government owned entities. And similarly, then the ETF also mimics the index and invest in those companies. Now the question is, what if the rating gets downgraded from AAA to AA? And so what will happen in such cases, if the rating gets downgraded from AAA to AA, we have a quarterly rebalancing of the index. So the next quarterly balance, so our rebalancing of the indices happen every quarter end, which is March end, June end, September end, and December end. So depending on which month it happens, that particular quarter end, this particular company will be removed from the index, and accordingly even the fund manager will have to sell the corresponding bonds from the ETFs and buy the bonds of the new company, which if any new company comes into the index. So that is how it will work.
Mukesh, can I just add there?
Yeah.
So firstly, I want to say hi to Bharat Bhai because I know who this is, Bharat Bhai from Ventura. You know, he's the first person I met when I moved back to India 10 years ago. So I'm very, very fond of him. One point that people make is that, you know, is there going to be a significant liquidity issue for the ETF in equity? I would just say that when you go from AAA, the next rating is AA plus. Now, AA plus bonds are pretty liquid because there are a lot of buyers for these bonds. So just keep that in mind. When we think downgrade and default, we think D and E and all this stuff today. So AAA to AA plus. Just that.
Okay. Now I think there is one question from Mr. Mahesh Oja. His question is, earlier we have seen discounted rate on exchange. So it's time being or any other reason?
So I think you are the expert of the exchange, but I think what you have seen is, and I'm just pulling up this, the 2030 has been at a premium 84 out of 100 days. So it's largely been at a premium. I think that's demand. The 2023 has been at a premium. I think after it lost its tax status, because now it's not eligible for
Radhika, let me answer this question. So basically, if you look at it, as all of us know in the bonds, as the yields go up, the prices come down, and if the yields come down, the prices go up. So I think if I remember correctly, what had happened in March last week or second half during the COVID time, when the COVID was at its peak, there was a lot of volatility in the markets. I think last 2 weeks the yields had gone up, because of which if the yields go up, temporarily the price would have slightly come down. So that could be the only reason, if I remember correctly, Radhika. And otherwise, the beauty of this is these are target maturity indices or target maturity ETFs. If you hold on to the ETFs till maturity, you are likely to get the yields at which you had entered the ETFs.
Yeah, Mukesh, that's right. And I think that's right. I would just add on the 2023, there was volatility, but also remember that after April 2023, it's not eligible for capital gains taxation. So that impacts the 2023 a little bit in terms of its premium and discount. 2030 has almost always been at a premium. In fact, people are complaining that वो premium पे बैठा हुआ है.
That's
I
good.
get a lot of nice complaints कि we buy it from the exchange, मैम वो premium पे बैठा है.
Other thing is, I think some people are saying, can the PPT be shared? I think a lot of people are asking whether PPT can be shared, because then they can use the PPT for discussing with the clients, customers, or for the marketing purposes. So I suppose this PPT would be available on your website from where the people can download or something.
Yes, it can. I think I will also ask Niranjan to send it to you. Niranjan's on this call, so I'm hope this is a new PPT we made today. Actually, it's a nice one. So this can be shared. We'll send it to you. It'll also be on our website.
Okay, that's good.
But we'll still send it to you. I'll tell Niranjan to send it to you, or if he can note that down.
Okay. Okay, what else is there? And I think another question is it fixed income type, mutual fund type, or what it is? I think I want to answer this. Basically, people are asking what exactly what
What
type
is it like? I think it behaves like a bond or a open-ended FMP in nature. It has the diversification of a mutual fund and the management and tax efficiency of a mutual fund, and it trades like an ETF and has the liquidity and cost of an ETF. So I like to say it is a combination of all three. I think the closest proxy, fixed deposits are a closed proxy, tax-free bonds are a closed proxy, and FLs and roll-down funds are some proxy. I mean, it has features of all these three.
Correct. So basically, it has got a simplicity of a mutual fund and liquidity of a stock. That's what I would say.
Yeah.
So what else is there? I think most of the questions we have answered. In case any more questions, please feel free to ask us questions. We have Radhika, the expert, and Niranjan available with us for answering all your questions.
We are really looking forward to everyone's sort of wholehearted participation from the broking community.
So Radhika, I think that's what we will, and if no more questions, we will end it. So thank you very much, all of you, for your participation, taking out your time in the evening, late hours, the middle of the week, Thursday evening. Really, thank you very much for your part. In case you have any questions, etc., further, please feel free to reach out to us, and we will be more than happy to answer the questions or any queries, any information, etc., you need from our side. Kamlesh bhai, you would like to? Kamlesh bhai? Can't hear you.
No, thank you so much. I don't know whether I'm audible.
Now you're audible.
Okay. No, I think it's quite an exhaustive presentation which was done by Radhika and Mukesh. And I'm sure if there are any more questions, they can reach out to them directly. I think this is a great product, as initially when I mentioned, in terms of short-term liquidity, in terms of parking funds for the retail, and you could buy anything from 1,000 rupees upwards to whatever that you like with a multiple of a rupee. So, which is great planning in terms of putting your money over there. Thanks so much for hosting this one. Yeah.
So thank you very much. Thank you all. Thank you very much for taking time out and joining us. Thanks, Radhika. Thanks, Niranjan. Thanks, Hari.
Thank you. Thank you.
Bye.
Thank you.